Joining us right now is former SEC chairman and CNBC contributor Jay Clayton. And Jay, it's really good to have you here today. You are a former SEC chair, somebody who's in charge of looking out for investors, especially retail investors. And I just wonder what you think overall of the meme stocks, of watching situations where maybe a company doesn't trade in line with the fundamentals. It's been something where people worry that retail investors are getting ripped off, but these stocks have managed to stay at incredibly high prices for a very long period of time. What do you think about what you see?
Well, Becky, it's nice to be back. And what do I think about what I see? I think a number of things. As we've talked about before, retail investors being more involved in our markets, I think everybody likes that. Look, if you live to 65 today, you're going to live another 20 years on expectancy. That's a fundamental change over the last 50 years. And we all need to be investing for our retirement in order to have a better retirement. And the earlier you do it, the more you're exposed to it. Fantastic. So, democratization of access, lower cost of access, all of those types of things, super for the retail investor. And as a regulator whose job it was to protect the retail investor, when people get into trading, not investing, but trading and following trends like that, you do get worried because over time the retail investor does not do as well as the institution in those types of trading scenarios. So look, we're not going to stop people from trading in public equities. It's a good thing. But programs like this are super because you've brought up some things. I've made it to listen in the last 15 minutes or so. Relative market cap, comparison to competitors, comparison to companies that are on the edge. All of those things are important for investors to understand. And I just caught you a second ago. It does trouble you when unrelated stocks trade in tandem because they have similar names. No one likes that.
Right. And that's where it's really hard to find some sort of a common denominator or some sort of theme where you can say this is bad or this is good. You want to see retailers getting involved in investing, but is this investing when they are trading very quickly in and out of stocks, and particularly so heavy on options that expire in a very near term?
Yes, and again, we've talked about it before. It's different to be in the cash market than it is to be in the options market or buying stock, on margin. We talk about financial literacy. I've been on with John Hope Bryant to talk about this. It's a big step up to go from cash investing to buying options and buying stock on margin or shorting stocks. You have to have a much better understanding of short-term market movements and how costly they can be. You can be right over the long term, but if you use leverage, you can have substantial losses nonetheless.
Did it surprise you after 4 days of trading, 4 days from its IPO, to hear that Robinhood was going to be selling more shares? And these aren't shares that it was selling to maybe take the proceeds and put back into the company. These are shares to pay off early investors, like the big VC firms that were longtime investors in it. Is that weird? Does that strike you as being odd or not?
Look, I'm not close enough to the situation to comment on, providing more secondary shares. But what you did see, and market commentators have noted this, is a clear supply-demand imbalance, particularly out of the gate. I think Jim Cramer, I caught him last night, mentioned this, that there just wasn't borrow available for people to take the other side. And it's sort of a fundamental supply-demand imbalance out of the gate. And to the extent that those shares being available has people looking and saying, okay, there's more supply in order to be able to take the other side of the trade, that may be helpful on the volatility side.
Was that anybody's fault for not getting the supply-demand right, or is that just a strange circumstance because we couldn't have anticipated that retail investors would be so interested?
I don't know. It's hard to say that there's some fault here. But what I do think the women and men at the SEC are looking at is, the amount of information that is available about short interest, short supply, aggregate short interest, whether it's timely enough, those types of things. And look, our trading dynamics have changed a bit. There's greater retail flow. Those are smaller orders. We've talked about those going to internalizers and wholesalers as opposed to the lit markets that we talk about. Those are things that I know Jared Gensler is a very smart guy. He's looking at these things. The staff is looking at these things, and you need to constantly do that. So this will be another data point as people look at our market structure.